again, and thanks for joining us on another edition of CMP TV. I'm Farkle McAlinton, news editor at Canadian Mortgage Professional. So another intriguing 12 months is ahead for us in the mortgage industry in 2025. We have interest rates hopefully on the way down, new mortgage rules coming into play as we know, but there are also plenty of challenges ahead as we gear up for the coming year. So for brokers, that means plenty to ponder as the 2025 market kicks into gear. And with me today to discuss some of the things that they should be keeping top of mind and focusing on throughout the year ahead, I'm very pleased to welcome Hugo das Reis. Hugo is the founding partner and managing broker of Vine Group and is joining us today from Toronto. Hugo, how's everything with you? Good to see you.
Good. Thanks for making some time to chat. Very good. You know, we're wrapping up 2024. It's been a bit of a roller coaster, but you know, I have to say that now that we're at the end of the year, we can see the light at the end of the tunnel. There's definitely a lot more optimism. You can see it with the conversations with the clients. You can see it with just the market in general, react very positively to these rate decreases. So yeah, we're pretty happy, and it's been an interesting couple of years, but we're happy to be wrapping up this year, looking to 2025.
All right. Well, looking forward to discussing, Hugo, what's in store for 2025. But first of all, since it's so fresh in people's minds, let's take a look back at 2024. What were some of the main trends that you saw last year, and how would you describe the year as a whole?
A tough year, but I'm always very optimistic, in that everything happens for a reason. I think the last 2 years were very difficult. We obviously saw rates go up quite a bit. But this is probably an unpopular opinion, but it was probably needed. I mean, buying a property that required you to go $200,000, $300,000, $400,000, $500,000 over the listing price, and you couldn't even go see the property, which was the reality just a few years ago, it didn't make any sense. And that's the world we were operating in. And I think that obviously created this unnecessary bubble. And, and it resulted in all the rate increases that we saw as a result of that, among other things as well. And it was a bit challenging. And the last years, the conversations have been difficult. They've been conversations around, hey, I'm about to lose my job. I'm about to lose my house, or more than several houses if they were investors. I need to refinance because I've got all this debt. They're really difficult conversations. I guess the positive side of all of it is it sort of forced brokers and the whole community of mortgage specialists to go back to basics. It was no longer you have all these new purchases on the silver platter. Let's just find a mortgage and let's just keep hammering deals. It went back to basics. Like, you should be offering real advice. Anyone who's been doing this long enough remembers when, there weren't these boom times, that things were a little bit slower, and offering real advice is how you were creating value with your clients. So offering that financial advice, making sure you were doing the right thing for your client, and finding exit strategies. So as their situation improved and rates improved, they were going to be better off as well. I think it filtered out a lot of really bad brokers. I think it eliminated a lot of really bad realtors or part-time realtors or part-time brokers. And it allowed us to almost refresh or cleanse. I don't know if that's a good word, but it allowed us to go back to the basics and keep a lot of the strong brokers around to make sure that we're offering the right type of advice. Because at one point, we were getting a bit of a bad rep, with the type of files that were being done. And even now, the stories around frauds that are coming out are crazy. A lot of that coming out of just greed. So I would say 2024 was kind of the tail end of that whole roller coaster ride. We had a lot of uncertainty at the beginning of the year, and I think we were very, very optimistic at the beginning of the year. But I don't think we saw the spring-summer market that a lot of us expected. I think it was a little bit milder than what we anticipated. But towards the second half of the year, with all the rate drops that we saw, the optimism around, the market, I think we're really, really expecting an interesting 2025. And we're recording this almost at the beginning of December 2024. Mm-hmm. And as a company, we've been extremely busy and have not really seen our volumes fall off significantly. So it's been interesting. And we're looking forward to, again, what I think would be a normal 2025, where you kind of have your boom period during the spring and summer. But I mean, who knows? Anything could happen. But I think the worst is behind us. I think is the most important messaging we're giving our clients now.
Yeah, for sure. And I think that's what a lot of people want to see, is just balance, right? They just want to see a normal market without the kind of crazy highs of a few years ago and the crazy lows that we've seen over the past couple of years. So a balanced market in 2025 for sure is going to be good for everybody. But one thing that you mentioned, Hugo, I mean, interest rates, obviously a massive topic at the moment, and they always have been. But We're seeing rates coming down on the variable side. The Bank of Canada is in rate cutting mode, and we think that they're going to be for a while yet. So on the fixed versus variable question in 2025, it's obviously going to be a really big topic. I'm wondering what you're advising clients on that question at the moment and moving ahead for the next few months.
I mean, it's a tough question to answer in general for everyone. I mean, the answer is obviously everyone's going to have a different recommendation depending on your profile. If you're on a fixed income, if you're retired, if you're extremely sensitive to your budget, perhaps a fixed is the way to go because you don't want to see fluctuations. But in an ideal world, I've always been a big fan of variable. And I think maybe the last 4 to 6 months, we've been back to the variable conversation as being one of the better options up until recently. And that's the kind of recommendation I'd be offering to clients. I'd be saying, look, the average bank is going to be pushing a 3 to 5 year fixed. I can almost guarantee that 99% of the clients who are walking into a bank are probably being quoted a fixed rate because on paper, a 3 year fixed or a 5 year fixed compared to a variable is still cheaper and it just looks better. Your monthly payment immediately will be lower. But you have to look at the long term. And it's really easy to forget that your mortgage is not, 1 year. It's going to be several years. And a lot can happen in those several years. Look 3 years back. Look how much of a roller coaster that was as an easy example. So I think the variable, it can be attractive if you can get a very large discount off of prime. That is going to be the way to go over the long term. If the market believes that rates are expected to drop anywhere from 1 to 1.5% by the end of the year, that's the current economic forecast, and you build that into a variable rate discount, then you will be better off with a variable rate than a fixed rate. The other types of strategy we're recommending is if we're wrong about this variable versus fixed recommendation, then go with a variable rate. I think it's safe to assume rates are coming down, not going up. Let's see what happens in the next rate cuts and then reassess. If you don't like the idea of variable, then convert it to a fixed rate. Most lenders offer that feature. So it's almost like, you can eliminate the risk by having that option to flip it to a fixed if you change your mind. So this is why I think a variable is the way to go. And then lastly, the other big benefit is the penalty. 3 months interest penalty to get out of a variable rate. If you sell the property, which is in Canada, the average Canadian breaks their mortgage every 3.5 years. So there's a very high likelihood in 5 years, you'll need to break your mortgage or do something with that mortgage and having lower penalties of pouring. And as rates go down, penalties will increase as well. So again, in an ideal world, based on what we know, variable makes a lot of sense. But if you get a really, really good fixed and you're comfortable with the idea that you might not benefit in the next couple of years and you're on a fixed income, nothing wrong with that either. So it could be good.
Okay. And I mean, we're seeing a lot of debate as well at the moment as to whether clients are holding off on getting involved in the market because they think that rates are going to move lower in the next few months. I mean, where do you stand on that question? And when we look ahead to the spring market, what's in store there?
I mean, we think it'll be a record year, personally. I mean, we've had very slow a year this year and even the last 2 years. And in the meantime, we've had record number of immigration coming to the country. And a lot of individuals that were ready to buy 1 or 2 years ago sat on the sidelines. So there was a lot of individuals that just didn't do anything. On top of that, values came down quite a bit. So individuals who would have otherwise sold their property held on to them because they didn't want to give up the values, having to sell them at a loss. So I think a lot of people will go back, revisit, and if you were thinking of selling, you're probably going to put your property out there. And if you were thinking of buying, you're probably looking at 2025 being an attractive year if you haven't started already. In fact, I would say a lot of the smarter consumers are already looking and trying to avoid the spring, summer potential, bidding war situation. And we have a lot of those clients with that sort of mindset is I want to get in now. I see rates are going down. I want to avoid the spring, summer mess, which could happen. So I think it could be a little bit messy. In markets like Alberta, it's already been pretty competitive and they've been doing really well. But the larger markets like Toronto and Vancouver, I don't think have been anywhere near where they've been at the last couple of years. But I do think that we'll see a lot of activity because of all the pent up demand and just the lack of inventory. To be honest with you, so that's what we're expecting. To be honest, and we've been planning and preparing for that type of potential, that possibility as well.
Right. And one interesting thing that you mentioned, Hugo, is that the brokers and the agents that are left, that are still standing, they're the ones that are in it for the right reasons and they're really looking to grow their business and help clients through this time. I'm wondering what your thoughts are in terms of what the top brokers in the country are doing to separate themselves from the rest of the pack in terms of, ramping up their preparations for next year?
That's a good question. So we have this conversation almost on a weekly basis on our national calls with our team. So, as a brokerage, our value proposition has always been attracting the best of the best because of the resources and infrastructure we have to allow agents to grow beyond what they would have done on their own. And so these conversations come up a lot. So I would say the top agents are able to pivot and accept that the current economy and the current reality we have is different. So whatever we were doing before, whatever systems and processes and even recommendations or advice you're offering, you have to pivot. The reality is deals are getting harder. It's harder to get a deal done. It's extremely competitive. There's a lot more options out there. There's a lot more information for clients to find access to better rates and so on. So it always comes down to a conversation about rate. But any really, really good broker should be able to pivot around the conversation rate and say, hey, Fergal, listen, I know the rate's important. I get it. But these 5 other things you told me are also really important. If I can address these first, let's then find the best rate with those items there. Because the reality is you might sell this place. You might have a large bonus. You might need that prepayment. You might want to make changes and add a line of credit or renovate or refinance. Like, let's make sure we can lock that down and get you a fully customized solution. So again, the top brokers are having those conversations and are not facing the challenges around rate. Because again, everyone wants the best rate. For any consumer who doesn't know the in and outs of mortgages, their default is, well, give me your best rate. But like anything, that comes at a cost. Sometimes the lowest rate is not the best option. We always say it's not the rate that matters, it's how much you actually pay. If you got the best rate of the market today, they ended up paying thousands or tens of thousands on a penalty because you didn't forecast, or the individual that set this up for you didn't tell you about all these limitations, and you didn't get a good deal. So the top brokers are just having better conversations. And this is why I'm kind of, odd way, happy to some extent that we had this bit of a roller coaster ride, because it did kind of cleanse the industry a little bit of all these poor behaviors and poor practice that we were seeing, and allow us to go back to the basics and allow us to have really good conversations. So in my opinion, we're not really competing. I don't see myself and the rest of our team competing with the banks because we offer a completely different value proposition. We're not stuck with the policies of one lender. We have access to dozens and dozens of different options. And, someone is going to have a different life journey. They might be salary employed and become self-employed and be unemployed and then retired. And all of those things demand different solutions. And I think that, again, if you're asking the right questions, you're going to be able to satisfy those solutions. And in turn, you'll get access to a lot more referrals and so on. And that's what I think the top individuals are doing. I think it's going to be really, really rare that the top individuals only focusing on rate and that's their only value proposition. It's a very, very small margin in that world. And I know a handful of brokerages, I've been able to do that pretty successfully. But as an individual agent, if that's your only value proposition, I don't want to be you. I don't want that headache and all those. It's really just a transaction. It's basically you're operating a factory at that point. So best to do the right thing for your clients, pivot, with the industry and based on what's happening and, as needed, and you'll always come out ahead. Those are the basic principles. It doesn't even sound crazy. Those are almost obvious things. I think sometimes people complicate things too much.
Yeah, absolutely. And I mean, one thing that I hear all the time when I'm talking with lenders is that whenever they're dealing with agents and brokers, a very common mistake or misstep that they see brokers making is that they're not maybe submitting as much information as they could or should for a file, maybe one that's on the borderline, and that's a real gripe for lenders at the moment. But I'm wondering, Hugo, if there are any kind of other common missteps or mistakes that you're seeing agents making at the minute, and what are your suggestions on how they should correct those?
So that's a good point. So as a brokerage for the last many years, we've always been really big proponents of docs upfront. And our definition of upfront is different than the average broker. When we say docs upfront, I literally mean I need every single document possible and probably more, because I need that information to assess where of the many dozens of lenders I can go to. And if your file encounters challenges, and in my world, that's always the reality, if I already have a document or I already understand some gap that you've addressed for me, I can deal with that immediately versus coming back to you and trying to, collect stuff that I should have up front. So we've always been really big fans of that. And because of that, we've built that into not only our process internally, but also in the technology that was created for our team and our clients as well. And as a result of being very docs upfront and having the whole story, a really strong KYC or know your client conversation, I find that we're not only able to pivot solutions when, again, challenges come up, but also the lenders are able to operate a lot quicker with the files that we're submitting to them. So if I'm submitting a deal to you that has all the documents, I've addressed all the challenges upfront for you. I've clearly told you what I need, and I explained my rationale to get that approval. That deal is going to look a lot more favorable than the other deal that's missing half the documents for a broker that cancels deals almost half the time. So we get favorable treatment because of that. And we've actually created some pilot programs with some lenders, allowing us to send in documents and we get an approval with all the conditions satisfied up front versus a traditional lender, which will send you a commitment and you have to now chase the client for documents. So we've always been big fans of that for many years now. This is not even new for us. And we're slowly seeing a push for efficiencies with lenders. Lenders are finding that there's a lot of inefficiencies with deals getting canceled, deals getting reworked and changed, and docs missing, and so on. And that makes complete sense. I mean, as a lender, if for every 5 deals you're receiving, you're only funding 1 or 2 of them, that's massively expensive as a business. So for us, it hasn't been an issue. We've ingrained that into our clients and we've engraved that into our agents as well. And yeah, you're going to get clients that are going to say, well, I bank with RBC. They just needed like a pay stub. It's like, yeah, but you know what? RBC is a big bank. They have all your bank statements. They've already reviewed your ID. They can see the direct payroll deposits. They probably have your investments. I don't have anything, but where I can bring value is I can collect this and navigate all these different options. So I think if you're firm on that ask to your clients in the beginning, I would say most of the time clients have no issue sending the full package. And the ones that do push back are clients you probably don't want to work with because they were never serious about giving you the documents. So I think that as brokers, we owe it to ourselves to ask for everything up front, to properly assess our clients' files. And that way we can also manage expectations. Just like going to your doctor. If your doctor says, I need these 5 things to deal with your surgery, you're going to do it. You're not going to ask too many questions because you just assume that they're a professional. They're acting in your best interest. So it's the same thing, I think.
Okay, excellent. And Hugo, before we wrap things up, anything that you want to leave our viewers with? Any last advice to brokers as we gear up for a really busy 2025?
I mean, look, again, I'm generally a very optimistic and positive person. I would say don't wait for 2025. Don't wait for the potential for a great 2025 season. Create your own opportunities. Right now, we're at the end of the year. We're going into 2025, which is expected to have an impressive real estate market. But again, don't wait for that. Look at the clients that you have now. Reach out to every single client you've dealt with in the last handful of years and just ask them for a phone call. You'd be surprised how many of those clients would appreciate that and probably have a real need for you to offer some advice and maybe a solution for them. And if they don't have a need, they're just going to appreciate that and probably refer you to someone else. So create those opportunities yourself and never say, oh, the market's been so bad. Because you know what? The market's been bad for a few years, but we're not complaining about it. We're finding other ways to find opportunities and find other conversations to have with clients to continue to add value. So my advice is, look, get yourself out there, don't wait for things to happen and, fill up your bucket so that if the real estate market does in fact get pretty crazy in 2025, you're already ahead of the curve. You're already doing well, and you already have the processes and infrastructure in place to be able to do better. So that's my message. And it's great going into 2025. It's also great. You should be at this point planning for next year. And with the holiday season, everything's generally pretty optimistic and fun. Let's kind of keep that energy so that next year we can continue to do really well. And yeah, I think it's good for the industry and it's good for clients. And yeah, we're excited to see what's coming.
All right, great stuff. Well, look, I think that's probably the perfect place to end things today, leaving on a high note. So thanks again for joining us today, Hugo. Really appreciate your insights as always. We're looking forward and the industry is looking forward to a big 2025. So we will certainly keep in touch and catch up with you in the next few months to see how everything's going.
Thank you. Thanks for appreciate your time. Happy holidays and Happy New Year too.
All right, well, that is just about all we have time for on today's edition of CMP TV. My thanks once again to Hugo Reis and Vine Group for joining us today. Thanks to you for watching, and we will see you next time.